The most expensive decision in investing often takes less than 10 seconds. It is the moment you open your phone, see a market falling, feel your stomach tighten, and press sell. Not because your original analysis changed, but because fear took control. And then the opposite happens. The market is rising. Bitcoin is everywhere. A technology stock is making headlines. People around you are talking about how much they made. Suddenly, you press buy. Not because the opportunity is better than it was last month, but because you are afraid of being left behind. That is not investing. That is emotion pretending to be analysis. Today, I'm going to show you why the human brain is often your greatest liability in the market, how institutional investors try to remove emotion from the decision process, and why risk management, not prediction, is the foundation of long-term survival. Hello, I am JM. For more than 30 years, I have worked in wealth management and investment analysis for sophisticated investors. They fail because they have no disciplined process for acting when their emotions become loud. Before we begin, this video is for educational purposes only. It is not personal investment advice, and every investment involves risk, including the potential loss of capital. The objective is not to promise returns. It is to give you a clearer framework for thinking and acting like a risk manager rather than a gambler. Let us start with the basic problem. Human beings are not naturally designed to invest rationally. We are designed to avoid danger. When we see a fast decline in the market, our brain does not calmly calculate probabilities. It sees a threat. The body reacts before the spreadsheet does. That is why panic selling feels so convincing in the moment. You are not thinking, does my original investment thesis still hold? You are thinking, make the pain stop. Then markets recover, volatility fades, and the exact same person who sold out of fear is often waiting to buy back in at a higher price once the headlines feel comfortable again. The result is a destructive cycle. Buy when the story feels safe, sell when the story feels dangerous, and repeatedly transfer capital from the emotional investor to the disciplined investor. Think about the pattern we see around Bitcoin, Ethereum, or major technology names. When prices are moving rapidly higher, the conversation is rarely about risk. It is about what someone supposedly missed. People start treating a price chart as proof that the future will be easy. But when volatility returns, the story reverses overnight. The same asset is suddenly described as finished. The same investor who wanted more exposure at the top wants no exposure near the bottom. Here is the uncomfortable truth. The price did not change your personality. The movement in price simply revealed that you did not have a decision process. I have seen investors spend hours choosing the exact entry point, but no time deciding what would prove them wrong. They know how much they hope to make. They have no plan for what they are willing to lose. That is not a small mistake. It is the mistake. Because without a defined loss limit, every position can become an emotional negotiation. You tell yourself, I will wait one more day, then another day. Then you stop looking at the account altogether. The position is no longer managed according to a plan. It is managed according to denial. The market does not reward conviction by itself. It rewards disciplined decisions under uncertainty. The second emotional trap is the headline. A headline arrives after something has already happened. By the time a major price move is everywhere on social media, the market may already have absorbed the information, repriced the asset, and positioned ahead of the crowd. What is the market already pricing in? Where is liquidity likely to sit? What would invalidate this idea? How much capital can I reasonably risk if I am wrong? And most importantly, is the potential reward meaningful relative to that risk? A disciplined process can consider market news, but it does not allow a headline to make the final decision. It uses predefined rules, price behavior, liquidity conditions, position sizing, and risk limits to decide whether an opportunity is worth taking. At Venture Capital, our approach is built around systematic analysis and risk management. The purpose of a system is not to predict the future with certainty. No honest investor can do that. The purpose is to create consistency. The same criteria for entering, managing, and exiting a position regardless of whether the person looking at the screen feels confident, fearful, tired, excited, or pressured. That consistency is the real advantage. A system cannot remove market risk. It can remove many of the self-inflicted mistakes that come from impulsive decisions. So, what does an institutional process actually look like? First, before entering any position, the process defines the reason for the trade, not a feeling, not a rumor. A reason that can be explained in one or two sentences. For example, is there a measurable price pattern? Is the market showing a change in momentum? Is there sufficient liquidity? Does the proposed trade meet a predefined risk-to-reward requirement? Second, the process defines the point at which the trade is wrong. This is where the stop-loss concept becomes important. A stop-loss is not an admission of failure, it is a business decision. It says, if the market reaches this level, the evidence no longer supports my original thesis. I will exit, preserve capital, and look for the next opportunity. Amateur traders often see a stop-loss as painful because they measure success trade by trade. Professionals view it differently. They know a small controlled loss is the cost of staying in the game. Third, the process defines how a position will be taken off. This could involve a profit target, a trailing mechanism, a time limit, or a change in the underlying market structure. The important point is that the exit plan exists before emotion arrives. This is why a quantitative or rules-based approach is valuable. It asks the same questions every time. It does not wake up anxious. It does not feel pressured by a viral post. It does not move a risk limit because it wants to avoid being wrong. Of course, any model has limitations, markets change, liquidity can disappear, unexpected events happen. That is why a system needs monitoring, position limits, and ongoing review. Rules are not magic, they are guardrails, but without those guardrails, your emotions become the strategy. Now let us talk about the concept that separates speculation from risk-managed trading: asymmetric risk. The principle is simple. Before entering a trade, you should know how much you are prepared to lose and what potential reward would justify taking that risk. Imagine two different approaches. In the first approach, you risk $1 every time you trade in order to make $1. You need to be right frequently just to overcome normal losses, spreads, fees, and mistakes. In the second approach, you risk $1 only when the potential reward is meaningfully larger. Let us use $3 as a simple example. That does not guarantee that you will make $3. It means your process only considers opportunities where the upside could justify the downside. Why does that matter? Because no trader is right all the time. Not a retail investor, not a hedge fund, not an algorithm. If you risk 1 unit to seek 3 units, and if you manage losses consistently, you do not need perfection to create a more resilient decision framework. You need discipline, you need position sizing, you need the willingness to exit a trade when the evidence changes. This is the mathematics that many emotional traders ignore. They fall in love with being right. But financial markets do not pay you for being right on social media. They pay you when your gains, losses, and risk exposure are managed intelligently over a series of decisions. Let me make this very clear. A 3-to-1 risk/reward ratio is not a promise. It is not a shortcut. It does not mean every trade will succeed. It is simply one disciplined way to ensure that you are not risking large amounts of capital for small, random gains. Your first job in any market, stocks, crypto, or foreign exchange, is not to make money tomorrow. Your first job is to avoid a loss that takes you out of the game. If you remember nothing else from this video, remember these 5 rules. Rule number 1, never enter a position without defining the point at which you are wrong. Rule number 2, risk a small, predetermined portion of capital on any one idea. One trade should never have the power to damage your financial future. Rule number 3, do not chase a move simply because it is popular. If you missed it, you missed it. There will always be another opportunity. Rule number 4, review your process, not just your profit and loss. A profitable trade can still be a bad decision if you ignored your own rules. A small loss can be a good decision if you managed risk correctly. Rule number 5, separate market education from personal financial decisions. A market insight can be useful, but it is not automatically suitable for your objectives, time horizon, or risk tolerance. These rules will not make the market predictable. Nothing will. But they can make your behavior more predictable, and that is where control begins. The biggest myth in trading is that success comes from finding a perfect prediction. It does not. Success comes from accepting uncertainty, defining your risk before you act, and refusing to let fear or excitement rewrite your plan after the trade is live. Mathematical discipline will always be more dependable than a moment of panic or euphoria. If you want to learn how a venture capital applies a structured, risk-managed, data-driven approach to market analysis across equities, crypto, and foreign exchange, visit platform.aventure-capital.com/offer/full-access. The link is in the description. And if this video helped you see the difference between reacting emotionally and managing risk professionally, subscribe to Be Rich Formulas. We are here to help you think like an investor, not a gambler.